In the early 2000s, a powerful story began circulating across financial media. This Mediterranean fast casual chain was the next Chipotle. Analysts repeated it. Commentators amplified it. Investors embraced it. The idea was simple and seductive. Take the assembly line efficiency of Chipotle, replace burritos with hummus and harissa, position it as health-forward and premium, and scale it across suburban America. For a while, that story felt unstoppable. The company at the center of this hype was Cava. It wasn't just being valued like a restaurant business, it was being valued like a technology platform disguised as a lunch spot. The pitch went beyond bowls and pita. This was about digital engagement, loyalty ecosystems, lifestyle branding, a cultural movement wrapped in fast casual packaging. And investors were more than willing to pay for that dream. But by 2025, that dream ran headfirst into economic gravity. The stock fell hard. Growth projections were revised downward. The narrative shifted from category-defining disruptor to overextended restaurant chain. What had been marketed as a revolution began to look more like a trend that had simply peaked. To understand how that happened, we need to go back to the beginning. Unlike many modern IPO darlings, Cava didn't start in Silicon Valley or inside a venture-backed startup accelerator. Its origins were far more traditional. In 2006, three childhood friends, Ike Grigoropoulos, Ted Xenaristos, and Dimitri Moshevides, opened a full-service Greek restaurant in Rockville, Maryland. They were the sons of Greek immigrants, raised around kitchens and hospitality. Their first venture wasn't a fast casual chain. It was a sit-down neighborhood restaurant rooted in family recipes and community. The turning point came from something simple: dips. Customers became obsessed with their spreads: whipped feta, hummus, tzatziki. The founders realized the package versions had potential far beyond their dining room, so they began distributing their products in local grocery stores. In a subtle but important shift, the brand began separating the product from the physical restaurant experience. That separation would prove critical. Then came a new dimension of leadership. In 2009, Brett Schulman joined the company. He wasn't a chef, he was an operator. Someone who understood scale, systems, and growth. In 2011, they launched what would become the defining model: Cava Grill. The concept borrowed heavily from the fast casual blueprint perfected by Chipotle. An assembly line where customers customize their meals. Choose a base, add a protein. Layer on toppings and sauces. Move down the counter. It was efficient. It felt interactive. And most importantly, it felt premium. The early 2000s were the golden age of fast casual dining. Consumers were drifting away from traditional fast food. They wanted better-for-you options. Words like quinoa, kale, and clean ingredients were becoming mainstream. Paying more didn't feel excessive. It felt responsible. Cava was perfectly positioned for that moment. By 2014, expansion accelerated, but organic growth. Opening one location at a time is slow and operationally complex. Real estate is expensive. Site selection is risky. Scaling nationally requires infrastructure. So in 2018, the company made a bold strategic move that would shape its future trajectory. They acquired Zoe's Kitchen for roughly $300 million. At the time, Zoe's operated over 300 locations but was struggling. Same category cuisine, underperforming footprint. For Cava, this wasn't just an acquisition, it was a shortcut. Instead of negotiating hundreds of new leases from scratch, they could convert existing Zoe's locations into Cava stores, swap signage, remodel interiors, install the assembly line format, reopen under a stronger brand. It was a real estate transformation disguised as a merger. And initially, it looked brilliant. Unit economics improved. Revenues climbed. The brand's cultural momentum accelerated. Cava wasn't just selling food anymore. It was selling a Mediterranean lifestyle package for the American office worker. Then came June 2023. The IPO market had been cold. Tech valuations were volatile. Investor sentiment was cautious. But when Cava debuted on the New York Stock Exchange, enthusiasm returned almost instantly. Shares were priced at $22. They opened at $42. By the end of the first trading day, they closed near $44, giving the company a valuation close to $5 billion. That valuation was striking, especially considering the company had not yet posted a full year of consistent profitability. But the narrative was powerful. This was the next category-defining fast casual empire. Financial networks repeated the comparison to Chipotle. Analysts modeled aggressive expansion scenarios. The company emphasized digital ordering, loyalty membership growth, and operational leverage. For a while, everything worked. Same-store sales climbed at double-digit rates. New locations opened rapidly. Momentum fed valuation, and valuation reinforced confidence. But beneath the surface, something subtle was changing. The economic environment that had supported premium-priced bowls was beginning to shift. Inflation had been eroding purchasing power for years. Consumers were growing more cautious. The assumption that $15 to $18 lunches were the new baseline for American life was about to be tested. And soon, the test would begin. By late 2023 and into 2024, momentum around Cava felt unstoppable. Same-store sales were rising at double-digit rates. New units were opening consistently. Digital engagement numbers looked impressive. The loyalty program was expanding. Analysts praised management for operational discipline and brand clarity. Investors, hungry for a growth story in a shaky market, piled in. By mid-2024, the stock had surged past $100 per share. By the end of the year, it briefly traded above $150. For a restaurant chain that had gone public at $22 just over a year earlier, the ascent was dramatic. One new grilled steak menu item became a breakout hit, driving traffic and social media buzz. It reinforced the perception that Cava had pricing power, the rare ability to charge premium prices without alienating customers. In earnings calls, leadership projected confidence. The growth runway, they argued, was long. The United States had hundreds of untapped suburban markets ready for Mediterranean fast casual. The phrase "next Chipotle" continued to echo. But here's the key problem. Investors weren't just buying a restaurant company. They were paying textile multiples for it. Valuation in public markets often relies on a simple idea. The multiple. A company's price-to-earnings, P/E ratio, reflects how much investors are willing to pay for each dollar of profit. High-growth companies can command higher multiples because the expectation is that future earnings will expand dramatically. By early 2025, Cava was trading at more than 40 times earnings, roughly double the industry average. That pricing implied near-flawless execution, steady expansion, resilient consumer demand, and minimal economic disruption. That's a dangerous assumption in the restaurant business, because restaurants are not software platforms. They sell perishable goods. They depend on foot traffic. They operate in a brutally competitive landscape where consumer sentiment shifts quickly. And sentiment was shifting. Inflation had been persistent. Housing costs were high. Student loan payments had resumed. Credit card balances were rising. By late 2024, cracks were forming in discretionary spending across the industry. Even established players began to feel it. Chipotle reported traffic pressure. Sweetgreen struggled to justify premium pricing in certain markets. Value-focused chains quietly began rolling out promotions and limited-time discounts to drive traffic. But Cava made a deliberate choice. They refused to discount. CEO Brett Schulman publicly emphasized brand integrity. Discounting, he suggested, could dilute long-term value. Temporary promotions might boost short-term traffic, but they risked repositioning the brand in consumers' minds. Cava was premium. It wasn't going to race to the bottom. In 2024, that stance looked disciplined. In 2025, it began to look rigid. While competitors experimented with bundled meals, loyalty incentives, and aggressive price promotions, Cava held the line. The assumption was that their customer base, urban professionals, health-conscious millennials, higher-income suburban families, would remain resilient. For a while, that assumption held. Then, the broader economic divide became more visible. Economists began describing the environment as a K-shaped economy. Higher-income households were doing relatively well. Asset prices were strong. Travel and luxury spending held up. But younger consumers and lower-income households were struggling with rent, debt, and stagnant wages. And here's where Cava faced a structural challenge. Its cultural buzz. The Instagram photos, the office lunch runs, the brand identity had been powered heavily by younger diners. People in their mid-20s to mid-30s, students, entry-level professionals, creators, urban renters. The same demographic now facing financial pressure. When budgets tighten, consumers make trade-offs. A nearly $20 bowl with add-ons, tax, and a drink becomes easier to skip. Grocery stores look more appealing. Value menus regain relevance. Cooking at home, once dismissed as inconvenient, becomes practical again. By early 2025, management began using careful language on earnings calls. Phrases like macroeconomic uncertainty and consumer visibility challenges started appearing. Translated into plain English, traffic was softening and forecasting demand had become harder. At the same time, external pressures were increasing. Global trade tensions were flaring. Tariffs became a renewed topic of discussion in policy circles. For a company dependent on Mediterranean ingredients, olive oil, certain cheeses, specialty imports, supply chain volatility wasn't theoretical, it was operational. To hedge against potential disruptions, Cava reportedly increased inventory levels and stockpiled equipment for future restaurant builds. That tied up capital. It increased balance sheet risk. It added complexity to what had once seemed like a straightforward growth story. Suddenly, the business wasn't just about serving hummus efficiently. It was about managing global sourcing risk, moderating labor costs, controlling build-out expenses, and navigating a consumer slowdown, all while trading at a premium valuation that left little room for error. And Wall Street does not tolerate disappointment when expectations are high. By mid-2025, the gap between narrative and reality was narrowing. The market still wanted to believe in limitless expansion. But the early signs of strain were there. Softer traffic in certain demographics, cautious guidance language, rising macro headwinds. The question was no longer whether Cava could grow. The question was whether it could grow fast enough and profitably enough to justify the price investors had already paid. The answer would arrive sooner than most expected. The turning point came in August 2025. Up until that moment, many investors were still holding on to the long-term growth narrative surrounding Cava. Yes, the stock had cooled from its peak. Yes, there were signs of consumer fatigue, but optimism hadn't fully disappeared. Then the company reported second quarter earnings. On the surface, the numbers didn't look catastrophic. Revenue was still growing year over year. New restaurants were still opening. Profitability hadn't evaporated. But markets don't just react to what happened. They react to what management says will happen next. And that's where the shock landed. For the first time since going public, Cava cut its full-year sales growth guidance. Analysts had expected revenues above consensus estimates. Instead, the company came in below projections and lowered forward expectations. In the public markets, a guidance cut is often more damaging than a weak quarter. It signals that management sees something changing beneath the surface, something investors may not have priced in yet. The reaction was swift. On August 13, 2025, the stock suffered its largest single-day decline since the IPO, dropping more than 20%. And this wasn't happening in isolation. Over the previous 3 months, shares had already fallen significantly, far outpacing declines in the broader restaurant sector. The story had shifted from temporary macro fog to structural concern. The core issue became clear. Younger diners were pulling back. The 25 to 35-year-old demographic, the group that helped popularize customizable bowls, clean eating aesthetics, and fast casual lunch culture, was trading down. Rising rent, debt payments, and economic uncertainty were reshaping spending habits. What once felt like a routine weekday lunch now felt discretionary. Consumers were reallocating, grocery spending increased. Traditional fast food regained traction due to value pricing. Promotions mattered again. Meanwhile, Cava's refusal to discount, once framed as brand discipline, began to look like inflexibility. Competitors adapted. McDonald's leaned into value bundles. Chili's promoted limited-time deals to drive traffic. Even fast casual peers experimented with targeted promotions and digital incentives. Cava held its premium position. Management argued that protecting pricing power preserved long-term brand equity, and in theory, they weren't wrong. Excessive discounting can damage perception and compress margins. But there's a difference between strategic restraint and ignoring market signals. By the third quarter of 2025, same-store sales growth slowed meaningfully. Unit expansion continued, but new stores can't fully offset weakening traffic at existing locations. When comparable sales decelerate, it forces investors to rethink growth assumptions. And growth assumptions were everything. At its peak, the company had been valued like a high-growth disruptor. But by late 2025, the market began reclassifying it as something far more traditional. A restaurant chain exposed to cyclical consumer demand. That reclassification compressed the valuation multiple. When investors believe a company can grow at 20% annually for years, they'll pay a premium. When they suspect growth may normalize to single digits or fluctuate with economic cycles, the premium disappears quickly. In November, management announced another downward revision to sales expectations. Shares fell again in after-hours trading. Confidence eroded further. The narrative transformation was complete. Cava was no longer the next Chipotle. It was being compared to the broader bloated fast casual sector, a term analysts began using to describe restaurant brands that had expanded aggressively during stimulus-fueled demand and now faced normalization. There was also a subtle cultural shift happening. For years, Cava had symbolized the aspirational office lunch, modern, health-conscious, slightly indulgent. But as economic pressure mounted, that symbolism began to change. Instead of representing mindful eating, it started to represent overpriced convenience. When a brand becomes associated with excess during a tightening cycle, the cool factor can evaporate quickly. And perhaps most importantly, the K-shaped economy dynamic intensified. Higher income consumers continued spending. Travel, luxury goods, and premium dining held relatively steady among affluent households, but middle-income and younger consumers, once core to Cava's brand energy, pulled back sharply. This created a narrowing customer base. Cava was increasingly reliant on a smaller, wealthier demographic segment. That's not inherently fatal. Many luxury brands thrive that way, but it contradicts the original mass-market growth narrative presented during the IPO. Meanwhile, operational realities became unavoidable. Restaurants are sensitive to labor costs. Ingredient inflation matters. Real estate build-outs are capital-intensive. Unlike software companies, margins aren't infinitely scalable. Every new location requires investment, staffing, and supply chain coordination. By late 2025, the market fully internalized that reality. The company wasn't collapsing. It wasn't on the brink of bankruptcy. But it was being treated like what it fundamentally was: a cyclical, consumer-facing business navigating economic headwinds. And when that realization sets in, valuations adjust accordingly. The hype had faded. Now came the harder part: operating through normalization without the cushion of narrative momentum. So where does this leave Cava? First, it's important to separate drama from reality. The company is not bankrupt. It is not disappearing. Restaurants are still opening. Customers are still walking in. The food hasn't suddenly become worse. What changed wasn't the hummus. What changed was the expectation. At its peak, Cava was priced as if flawless expansion was inevitable. Investors believed it could replicate the nationwide dominance of Chipotle without enduring the painful growing phases that most restaurant brands face. They believed the premium bowl had become a permanent staple of American daily life. But public markets are unforgiving when growth slows. By late 2025, the company's market capitalization had compressed significantly from its highs. Shares that once traded above $150 settled far lower. Still above the IPO price, yes, but nowhere near the euphoric peak. That kind of reset forces a company to mature quickly. When you're treated like a tech darling, you can talk about ecosystem expansion, digital engagement, and brand momentum. When your valuation compresses, investors start asking different questions. What are your margins? How sensitive are you to food cost volatility? What's your real same-store sales growth? Can you sustain expansion without sacrificing returns? The conversation shifts from vision to execution. and that shift can be uncomfortable. For years, the fast casual category benefited from powerful tailwinds: low interest rates, stimulus-fueled consumer spending, social media-driven food culture, and a generation willing to pay more for perceived quality and wellness. But tailwinds eventually normalize. The broader restaurant sector began what some analysts described as a deflation of bloated fast dining. During the boom years, aggressive expansion was rewarded. Concepts scaled rapidly, sometimes assuming demand would indefinitely support premium pricing. When economic conditions tightened, only brands with true flexibility thrived. Chains like McDonald's understood that value perception can be as important as quality perception. Casual dining players like Chili's leaned into affordability messaging when consumers felt squeezed. Cava chose to defend its premium identity. That decision may still prove correct long-term. Protecting brand integrity can preserve margins and avoid training customers to wait for discounts. But in the short term, it exposed the company to sharper traffic volatility. And that brings us to the real lesson. Cava's difficult year wasn't about Mediterranean cuisine. It wasn't even strictly about pricing. It was about hubris. The belief that a brand can transcend economic cycles. No restaurant is immune to macro conditions. You can have excellent product quality, you can build a loyal customer base, you can execute expansion well, but if your core demographic experiences financial strain, traffic will respond. That's not a failure of branding, that's economics. There's also a deeper structural point here about public markets. When a company goes public during a moment of narrative strength, valuation often reflects future perfection. Investors model straight lines upward. They assume expansion without friction. They extrapolate recent growth indefinitely. But businesses rarely move in straight lines. For Cava, the transition now is psychological as much as operational. Management must operate as a disciplined restaurant chain rather than a growth phenomenon. That means watching commodity costs closely. Olive oil, produce, proteins. It means optimizing labor scheduling. It means carefully selecting new markets instead of pursuing expansion for expansion's sake. It also means reconnecting with younger consumers. The 24-year-old renter who once grabbed a bowl 3 times a week may now be cooking at home more often. Winning that customer back doesn't necessarily require deep discounts, but it may require creativity. Smaller portion options, strategic limited-time offers, enhanced loyalty rewards, perceived value without brand dilution. The path forward is about balance. Cava still has strengths. The Mediterranean category remains appealing. Health-conscious dining isn't disappearing, and the company proved it can scale operationally through its transformation of Zoe's kitchen locations. But scale alone doesn't guarantee valuation. The broader takeaway for investors is simple. Narratives are powerful, but they are temporary. Fundamentals endure. When the stock was soaring, many assumed the $18 lunch had become a permanent feature of American life. When the stock fell, some assumed the concept was broken. Neither extreme tells the full story. Cava is now in a more grounded phase. Less glamorous, more practical. It must prove consistent profitability, resilient traffic, and disciplined growth. If it succeeds, the brand may earn a second wave of investor confidence. If it struggles, it risks becoming another case study in overexpansion during a boom cycle. In the end, the lesson isn't complicated. In the restaurant business, if prices drift too far from what customers feel comfortable paying, traffic declines. If expectations drift too far from operational reality, valuations fall. The dips may still be great, but in public markets, taste alone isn't enough.